welcome to the audience. I'm really looking forward to this discussion. And if I think about the impact space, and we're going to talk about private credit, but probably impact more generally and also specifically throughout the course of this next hour, I think about the traditional markets around banking, around finance, around access to capital. And it really is the alternative markets that have filled that need. So I think the correlation to why CAIA is involved in this, when I think about the search for alpha, it's found in uncharted territories and smaller markets, and the ability to finance those markets and grow local economies is very, very important. And if you take nothing away from this discussion today, it's not about concessionary returns. It's about providing capital to what is going to be the future of this world in terms of population growth. And I think a lot of interesting stats to talk about there as well. But before we get into that, it's a great panel. I had the opportunity to spend some time with all four of these folks in the prep, and they cover a lot of different verticals individually, collectively. I was making light of the fact that it is a small club. I felt that they knew each other and I was the outsider, but maybe now they'll invite me in to a world that I think has awesome opportunities for the end investors. So maybe we'll just start with some intros. Gloria, and you're in my upper left-hand corner, so I'll start with you.
Okay, great. Thank you. I'm Gloria Nealand, the founder and CEO of TriLink Global. I founded the company after a long career on Wall Street, so I'm very old. And the whole purpose really of doing it was to help prove that investors don't have to give up investment return to do good. And from the beginning, I started the company in 2008. Our first fund got launched in 2012. But from the beginning, we've been a private credit impact fund, focused initially primarily on emerging markets or developing economies, though we did expand more globally in the last couple of years, and we've added funds and things like that. But we've always believed that private credit, from an impact perspective, can deliver significant impact. And what you said about the world and what the opportunity is for private credit is incredible. So thanks for having me.
Thank you. Thanks for joining. Ed?
So my name's Edmund Higginbottom. I'm the managing director of Verdant Capital. I'm dialing in today from Europe, but I'm based in Johannesburg. I'm based in South Africa. Our entire team is based in the markets in which we invest, and the entire team is drawn from those markets. Our flagship fund is the Verdant Capital Hybrid Fund. The motto of that fund is driving change, driving returns. Again, we don't think there's any conflict between receiving a commercial return and driving positive change to create dynamic economies in less affluent parts of the world. We invest in tech-enabled micro enterprise and small business lenders. We invest mezzanine capital. Talk a little bit more about the structure later on in the call. And Bill, thank you very much for inviting us to join.
Thanks, Ed. Patrick?
Yeah, my name's Patrick Fisher. I founded a firm called Creation Investments 16 years ago. We're entirely focused on financial inclusion, which is providing access to capital, credit, savings, insurance, payments, tools for the unbanked, underbanked populations of the world. We manage now over $2.2 billion, which is a phenomenal blessing and honor. We started out in private equity, but over the past few years have moved into private credit. Our whole belief is if we know how to underwrite a company, if we're willing to own it, we should absolutely be willing to lend to it if we can get the right structure and return. So we're very much coming at it from an operational standpoint and from our due diligence. We focus on India and Mexico, really core emerging markets, trying to get the right risk-adjusted returns, having certain beliefs about frontier markets, but ultimately we're all here because of the earliest impact lenders in the space that really use debt and private credit as a way to reach unbanked groups and small businesses. So private credit is, as the title says, the original impact investment and an absolutely phenomenal tool for portfolios to do good.
Thanks, Patrick. And Stephen?
So my name is Stephen Hester. I'm head of investments at Common Good Capital. And Common Good Capital is a combination of an investment bank and a broker-dealer, but everything we do is focused on global impact investing. Our primary goal is bringing exposure and capital to really high quality impact managers. And we also try to be a thought leader in the space. So we, author white papers, and we represent impact investing in a lot of industry conferences.
Thanks, Stephen. And I want to stick with you for a second, but just a housekeeping thing. I see Liz just dropped it in the chat as well. We will leave some time for questions at the end, so I encourage you to drop them in the chat box. We try to pay attention to them as we go along, but we want to try to make this as interactive as possible. So Stephen, the impetus for this, many reasons, but I got to meet your partner, Jeff Schaefer, at an ADISA conference about a year ago. Both prepping and then having him as a keynote. I learned a lot from him. And then he approached me about 2 months ago about this paper that you folks wrote, Private Credit, the Original Impact Investment. And I read it. It's excellent. We will drop a copy of it in both the chat and then post this call today. But I learned a lot from it, and not the least of which is even a basic thing for me. When I think about an entrepreneur, I think of that as a choice. And sometimes it's a default because there is no option in these developing markets where the population is growing so rapidly and the traditional areas of employment can't keep pace. And then that sets off a whole wheel of motions and emotions about access to capital, banking, using the internet, using the iPhone. So I think you'd be a very good person to kind of set the table around this discussion, and then we'll take it from there.
Yeah, this is kind of how I look at it, Bill. I was a due diligence officer for relatively big shops for a while, and that's one type of private credit, really, right? You think it's 50 types, but it's pretty similar. You're loaning to large businesses, and that's about it. But from working with, being fortunate to work with a lot of great managers with all kinds of different strategies in all kinds of different areas, you start to appreciate what you just said, that this isn't simply a business tool. There are huge, kind of in my view, what's in the paper, just very large gaps that are formed by regulatory systems, by governments, not necessarily intentionally, but it is what it is, where credit just isn't available to large parts of the population. And to someone maybe in the US or Canada, they might think, oh, that's just a pain. But in other parts of the world, it's not a pain. It means you can't feed your family. It's a big deal. And so being able to use financial inclusion, maybe directly kind of loaning to people, or perhaps working with intermediaries, which you can often have greater efficiency that way with your investment dollars. You can, yes, deliver pretty interesting risk reward profiles, but you're also kind of by design and by accident, giving people real jobs that they may not be able to get another way. I think that's kind of the reality. So that's how I would kind of frame it.
And just maybe a follow-up about, and again, something maybe Jeff mentioned to me, that anybody that's investing in the private credit space is probably an impact investor. And I'll take that argument from the other side, which is when Silicon Valley Bank went down, there were so many North American, US-based investors that were left wanting because their regional bank disappeared. They were the lender into this space. And I think it brings it maybe to a developed market perspective when you have a regional bank disappear and it gets swallowed up by one of the big money market banks and regulation comes down like a big curtain. It sucks out the oxygen and the access to capital for the entrepreneur.
Yeah, absolutely. I mean, this impacts a lot of people more directly than you might imagine kind of from the sidelines. So if you're trying to get, for instance, a commercial real estate loan, which used to be kind of a default, I mean, that was relatively easy to get for people. Well, large banks just don't do them very much. Regional banks were, depending on the metrics, between half and 70–80% of all commercial loans in recent years. And of the existing regional banks, this isn't going to surprise anyone, they're not doing that anymore, right? And the large banks that took those assets over are unlikely to kind of reissue those same loans when they mature. And so that impacts a lot of just regular people that maybe want to own the building they have their business in. That's just one concrete example, but absolutely. And I think in the US, an accurate way to look at it is a lot of the private credit kind of is maybe with slightly bigger companies is maybe where the dollars go. But it still has a very direct impact on individuals who may not get a job and not know it. Well, the reason you didn't get the job is because the company couldn't expand, because unless they have a credit rating, it's very hard to get debt, even in the US. And that's one of the reasons why having a kind of a healthy private credit lending market is absolutely critical, whether it's developing or developed countries.
Good point. So, Gloria, maybe to continue this discussion, maybe you've seen both sides of this coin. I don't have to name institutional names, but I think many of us, and I feel myself too, this trying to make an impact has come from probably the bigger part of finance, and there's nothing we need or should apologize about that. But it's interesting from your perch. You've seen a lot on both sides, and then also in your current lot. And in the green room, I was talking to you about one of the charts you showed around population. I alluded to that we talk about demographics in the U.S. and Japan, and they're not very good, but they're awesome in places like India and Nigeria. But the banking system is non-existent, and there's so many non-banks, people unbanked. So maybe just talk about some of your observations, perspectives about the impact space.
Yeah, the really interesting kind of tying even what Stephen said into what you just said. Going back clear back to 2008, right? The global financial crisis. Banks, big banks, some of the big banks anyway, the global banks, did have a small presence in some of these emerging market economies. But after the global financial crisis, all of those banks completely pulled out. And then you added to that what's happened recently, right, with the whole COVID and everything. And I haven't seen any updated statistics, but when we started in 2008, the IFC basically did a study on SMEs, and there was about a $1.4 trillion lending gap. This was back in 2008, 2009, I think was the study. And then right before the pandemic, it already had increased to $5.7 trillion in a lending gap. And again, I haven't seen new numbers, but you go, well, since even some of the banks that did reopen or stayed behind in those markets with the whole pandemic, everybody pulled out. And what's interesting is looking at it from a US perspective, right? Whenever our banks stop lending, there are alternative lenders who jump in to fill that gap because we have such an established financial market, right? Our capital market. And so here, even when we have those big hits, we don't feel it as much, right? In these places where the banking system doesn't really exist much to begin with, when what was there actually stops, then they don't have a lot of alternatives. And so there is a huge lending gap. And, I'm going to tie it now to what you said about population. You think about everything, Stephen said, and everything you said, Bill, about what drives an economy. In advanced economies like the US, it is our small and mid-sized businesses that create 90% of our jobs, generate 60% of our GDP, generate more than half of our exports. And they're the ones who give back to the local community and keep things going, creating jobs, like Stephen said, providing insurance, providing healthcare, all of those things that are so critically important to an economy. And if those businesses in these markets don't have access to grow their business, then they basically won't be doing all those things, right? Because they can't grow. And I think it's critically important with that kind of population growth in these markets that we find a way to get them financed, which is, I think, what a lot of us are focused on. So, and from an impact perspective, I used to get accused of thinking private equity is a bad thing. I don't. I think it's a bad thing. But the argument that I would make for private credit is when you're going into one of these markets and you're financing a company that's growth stage with debt, the nice thing is once they pay that loan back and they're successful in their growth, then all of that money stays in the local market, right? Even if they have some kind of an exit. If you're a private equity firm that's bringing in all this equity capital from the US, let's say, when there is an exit, which is how you get your money back, well, all that money comes back here. And so, again, I'm not saying private equity is bad because it's much needed. But from a pure impact perspective, I think you could make the argument that it's even more impactful when you're able to do credit because it keeps the ownership in the hands of the local people who then can spend that money in locally.
So just one quick follow-up tied to a question that came in, Gloria, about the shadow banking that has emerged out of this. My view, and you can take the other side of this, is I think COVID accelerated the inevitable around more regulation, and then Silicon Valley Bank took it all the way down to the small regional bank. And it really has taken access to capital away from the small businesses, which are the big job creators. And somebody's got to fill that niche. And if you look at private credit in total, it's well over $1 trillion today. Would that have happened if it were not for the GFC and Dodd-Frank? I don't know. But I think regulations pushing more and more of this access to capital up to the bigger institutions. So what are your views in the shadow banking? And we often, when you hear that, you think it's a bad thing, but maybe it's a necessity too.
Well, I guess that's what, there are two sides to that coin, as you just explained. We do have to keep capital flowing. We have to keep money moving, right? One way or another. One of the biggest challenges with all of it getting moved up to the bigger institutions is that the bigger the institution, the less interested they are in doing smaller deals. Because, if they've got, let's say, a $2 billion fund, well, if for them to do a $5 million deal, right, that's just not efficient for them. And so it almost forces this whole system of creating, you've got to have somebody coming in behind it because it's going to leave this middle market gap again, right? It just happens. And so I really do
structurally, that's structurally where a lot of these markets are that we operate in. If you look at the BRICS or other emerging markets, you've got the big banks on one side, which have massive balance sheets, and you have all these unbanked people on the other. And there's a funny joke in Chinese. I used to work there with JP Morgan, but in order to work at a bank in China, you need three things. You need to smoke cigarettes, read newspapers, and drink tea. And those were the three requirements. And ultimately, they're not terribly interested, either laziness or efficiency, to tap into these massive market needs. And that's created such a great opportunity for financial inclusion leaders to step up. We call them shadow banks here in the US, but in India, they're regulated non-bank finance companies. In Mexico, or in Peru, they're called EDIPYMEs. There are all sorts of regulatory structures that have sprung up in really good and secure and strong markets that have allowed for these smaller lenders to play that role and fill that gap at the micro level, for the $200 loan to the $1,000 vehicle loan, the $10,000 affordable mortgage. Creation's been investing in that on the private equity and the private credit side. And they're fabulous investments because the credit quality is there, the operating risk is low, and really we're able to price risk effectively, which is a lot harder in tighter margin markets like developed markets. You see it in Europe and in the US. So you're not really rewarded, which is why the shadow banks really sprung up.
Yeah, no, very good additive points. And I think this is a good segue, Patrick, because both you and Ed have a little bit more of a regional focus with a global view, but you, as best I understand, travel both in Mexico and India primarily, maybe not exclusively, and you just mentioned it a little bit, but some of the nuances, risks, opportunities in those markets.
Yeah, I mean, the global opportunity, like Gloria said, is huge. There are people and small businesses that lack complete access to financial services, and you can step in as a direct lender to lend to an SME, a small and medium enterprise, or through a financial intermediary. Because we focus on banks exclusively, and we underwrite regulated leasing company or a regulated insurance company, and we'll make a senior secured loan through our private credit portfolio. So we have a company in India that does used motorcycle finance. It's called Amrit Malwa. They do $700 to $1,000 loans to help somebody buy a used motorbike and a tuk-tuk, a three-wheeler. And with that asset, people are able to make enormous amounts of money. But you need that initial capital to buy that asset. So Amrit Malwa has a 15% return on equity. They're growing. They're at $60 million in loan portfolio, 100,000 clients, but they need more net debt and liabilities to keep their expansion up. It's a family-owned business, and so we deployed money out of our private credit funds and and that gets on lent to the end customer. Gets us about a 17% top line IRR, and we do that through this regulated environment that exists in India. As we mentioned already, there are about 400 million people that don't have a bank account, don't have access to credit through that. So there's just a massive amount of opportunity there, but the traditional banks aren't going to serve that. So that's where impact investors in particular can be the tip of the spear to operate in a market that already has all these great parts to the ecosystem: a legal structure, financial framework, capital markets, bank regulations, and then but is net in need of fresh capital. So we're often the first foreign lender, which helps them get better credit upgrades and access to new sources of funding once they pass through us. So it's a fabulous market to operate in a place like India or Mexico.
Okay, so a quick follow-up, and I'm testing Ed's patience with me, but maybe just make a quick comment on where you sit in the capital stack, the kind of collateral you have, and maybe the return expectation.
Yeah, so we are senior secured lenders. We're secured by loan portfolios. So we'll have 125% collateralization against $1 million. We'll have 1.25 million of collateral pledged to us, which are these vehicle finance loans, which hold title to a motorbike. We also will often have some cash collateral pledged, as well as the entire equity of these businesses. They're generally unlevered. I think that's something that Ed will comment on. But our institutions that are regulated finance companies typically only have anywhere from 3 to 4 times leverage. So they have an equity base, not at 8% like the US, but they have an equity base of 25%. I mean, unbelievable amounts of equity cushion. Even during COVID, the highest loss rates we saw were around 7% of a portfolio, which in a pandemic for vulnerable set of people is a pretty amazing thing to eat into 7% of equity. But there was 25% of equity cushion there within these institutions. So no lenders lost money during that time. So again, we're in the investment grade space, so triple B plus. But even with that, there's still no capital. Only when you get to the double A's do you ever see money flowing in these economies. So there's this missing middle gap exists even at the company level on the lower end of investment grade. So we think that's the perfect risk-adjusted return and a great place to deploy.
Okay, thanks, Patrick. So Ed, thanks for your patience with me. And as I said earlier, I think your area of expertise and business acumen is primarily in Africa, but maybe also, as I said to Patrick, maybe not exclusively, but maybe your view on impact in that region or any kind of global views you might have.
Verdant Capital is an Africa business. I'm based in Johannesburg. Our team is based throughout the African continent. Our team is hired from the markets in which we work. Everybody who's making allocation decisions, it's a process which is overseen by myself and the other members of the investment committee. Everybody who's involved in that process is deeply embedded in the community. We hire the majority of our people from local universities in different parts of the continent. These people grow up in this system. They have deep personal ties. They've got deep knowledge of how these markets work. We're deeply embedded in the ecosystem here. I'm a director of the Private Equity Association in South Africa, and sit on board in industry groups across the continent. And prior to being in Africa, I worked in the City of London. I worked at Morgan Stanley. I worked at Deutsche Bank. So we do understand how the global capital markets and how the financial system in the UK and in the US is very different to the markets in which we operate here in the continent. I think there's a lot of similarities between Africa, and we do what's happening in India, especially in other parts of Asia, a little bit about what's going on in Latin America. In Africa, especially, there's been a change in how financial companies interact with their customers. It's been very significant technology change in the last 20 years. So mobile money, mobile payments, mobile wallets, how data is gathered from the bottom of the pyramid customer by financial institutions. That's all changed. And I think, Patrick, to use your word, Africa is very much the tip of the spear in that change, in the ability to profitably deal with customers at low ends of the pyramid as a financial business and make profit, whether that's a motorbike leasing business in East Africa, or whether that's a working capital lending business in South Africa or West Africa. your ability to be profitable is much facilitated by this change in technology. And are the companies we're investing are making money? And so they should. They're taking the risk. They're supporting their customers. They're changing their customers' lives. We can talk a little bit about case studies later. And if we're supporting them, we want to make money too. We want to make money for our investors. Our investors are putting their trust and faith in us in a part of the world they may have little direct knowledge about. But that you can trust us because this is what we know about. We're veterans in this market. We're very, very experienced in this market. We've grown up with these businesses. We've grown up with these technologies as they changed. And ultimately, I think there's a lot of very interesting case studies and there's a lot of interesting learnings. If you take the number of people on food stamps in the US and call it a country, it'd be the 8th biggest country in Africa. And some of the challenges in the US in terms of people of low incomes and how they access credit or how they make their payments, how they get bank accounts, how they make simple financial transactions, some of the frictional issues that they deal with in everyday lives. I think there's actually a lot of learning from the ecosystem here. Some of the new businesses and new technology companies that have grown up over the last 20 years. I think some of that could be applied back on your side of the world.
So a follow-up and tied to a question that came into Ed. So I guess thanks to Dodd and Frank and maybe an accelerant might have been Silicon Valley Bank, but the traditional lending stopped and the shadow banking was created. And the question was, well, what's been the storyline outside of the US? And I imagine in a market like Africa, I was never going to be able to walk out my door, drop my dry cleaning off, get a Starbucks coffee and stop at my local bank. I think that infrastructure did not exist. And so you can react to that. Maybe shadow banking did exist or regular banking, I doubt it, but maybe the role of technology and the power of the cell phone and the internet, because I think that's been able to get people far and wide basically onto the grid when they have been traditionally unbanked.
So if you look at rich economies, and it's like getting very, very, very technical, we look at rich economies, you look at large upper middle income economies, bank assets to GDP is approximately 100%. So GDP, gross national product in the economy, and the banking sector or the size of private credit in the economy, it tends to be about 1 for 1. Some rich economies with big financial markets, UK, Switzerland, Hong Kong, can be 2 to 1. Much more than 2 to 1, it's a systemic risk. In Africa, we see anything between 20 and 40% bank assets, or anything between 20 and 40% private credit to GDP. What that means is that you've got between about 60 and 80% of GDP as bank assets, which are missing, that they just don't exist. That the banking system is not creating those assets. When I mean assets, I mean loans. And those loans which are missing are loans to SMEs and loans to people. So banks in Africa, they lend to the government. Banks in Africa, they lend to multinationals. They lend to expatriates, they lend to rich people. They lend to some very large African local businesses. There's very little lending to individuals to get car loans, very little lending to get a mortgage or a house, and really limited financing to get a motorbike to become a taxi driver. In East Africa, West Africa, taxis is not yellow cars, it's not black cabs like in London. It's you sit on the back of the bike, and that's how people get to work. And if you want to be a taxi driver, it's you don't get that loan from a bank, you get it from private credit business. So in response to that, over the last 2 generations, an industry's grown up called microfinance. And microfinance is probably the original impact asset class, original private credit asset class. And that has had a positive impact on people's lives. It's had a positive, it's given people a chance to start businesses. It's given people a chance to put food on the table for their families. What we've seen over the last 15 years, especially, is technology's changed. So the most expensive thing in the financial sector is cash. And that's a truism, but it's true. Handling cash, delivering cash, small amounts of cash. Remember, Africa's a big continent. It's 7 times bigger than India with the same population. handling cash is very expensive. Handling information was very expensive. Now we have a much more efficient ecosystem. That technology has changed, it's established. I can make a payment from my mobile phone. I can repay a loan. I can pay a customer. I can repay a customer. I can pay a supplier. I can receive payments. I can receive, if I'm a motorbike driver doing taxis, every customer pays me by mobile money. I pay once a week. When I take my loan, that information is, when I apply for my loan, that the information is gathered electronically. The credit scoring is done electronically. It's done in the cloud. And that's a very, very different picture to how financial services were affected in Africa versus 10 years ago. And we're in the process of this changing era. And the businesses who do this well are very, very profitable. And we're fortunate enough to, we know every company before they come to market.
Okay.
And we know every company. We know the CEOs, where they worked in their last job, where they worked with the job before. We know this. We know the backstory, and we're able to pick the top quartile from each of these new business verticals in the financial sector, and we invest in that top quartile. And our investment strategy is we do credit enhanced junior debt or stretch senior debt. That gives us a yield pickup versus many traditional operators in the sector. That gives us the ability to choose who we want to invest in, because we see in the senior debt market there being quite a lot of competition, and in the junior debt market there being virtually no competition. So we get the luxury of choice. We get a slightly higher yield, and we're much more catalytic. We're able to take these businesses from A to B. We can bring in a lot of our friendly co-investors on the senior side, and the ability to help these businesses and the ability they have then to change people's lives, and for them, their customers, and to put food on the table for their kids is very significantly enhanced.
Yeah, great. So it's just about the bottom of the hour, so we probably have an opportunity to go around one more time. And Stephen, maybe starting with you, and I'm reminded of something I think it was Patrick said to me yesterday about you're trying to use an example, maybe not by name, but if you're comfortable doing that, we could do that as well. Because I think if you hear a story, I think it brings all of these party lines together in a real life way. So maybe starting with you, but if you could preface it, I don't know if Common Good or you have any numbers about the size of this market, and maybe that's a very difficult question to answer, because am I including private credit all in, or just impact? And I think a lot of people think ESG and impact have a high correlation. That may or may not be true, but any sizing aspects to help the audience, and then maybe if there's a real life example that kind of pulls a lot of what we talked about together.
Yeah, let's see. So there's a good amount there, which is a positive. The private credit space may be, and I'm in Mexico City, which is a little loud, so I apologize if you hear something through the window there. But it may be frankly the most diverse institutional asset class, just in my humble opinion. So at the bottom of the pyramid, as Edmund stated, you've got financial inclusion at $40 loans, like 40 USD loans. And you're at the top where you might have an Owl Rock or an Ares loaning to a company that has 100 million annual EBITDA. They did that record private credit loan ever done was fairly recent. It was in the billions. So you really do have to kind of closely analyze which of these layers you're in. And in terms of scope, if we're looking at the top, you mentioned a good stat, it's over $1 trillion. And the growth is pretty impressive. It's kind of low double-digit compound annual growth rate for decades at this point, about 2 decades. That's the big number. At the smaller level, based on World Bank data, you've got at least 150 million active people with micro lending. Personally, I think that number is way too small, but I'm going to go off the World Bank's data there. So it's a pretty good chunk if you think of these populations, and not everyone in the population is suitable for a loan. An elderly person or a child probably doesn't have a loan. So if you think of 100 million in the context of the developing world of people who need, that are lower income, you're starting to hit a pretty big percentage of people that are impacted. And I'll give you one kind of interesting concrete example. If you think of someone who brings, like in Mexico City where I'm at, and this is not unique to Mexico, anywhere where that entrepreneurship is a requirement really to survive, you'll have people all around the city that are selling fruit, vegetables, whatever, right? Very convenient because someone doesn't have to get in a car to go to the grocery store or whatever. Well, they only have enough money to bring X dollars of food. We wouldn't think that way, but that's the truth, right? They can't bring 9 stalls worth of food. They cannot do that. So instead of bringing, enough where they can make a profit and then pay for food that day, they get a microloan and they make double. Okay, well, that's no big deal. Well, it is a big deal because now they can save money, which was never an option before. And if they do it well, they often will actually recruit other people in the community, and they kind of use each other's relationships with the microlender as like kind of a net gain, where there's a kind of a societal community responsibility attached to them, where, hey, I'm getting my loan through XYZ company. I introduced you to help them. You better not mess it up. I don't want to look bad because, you didn't do something properly. And there's this, I don't think the market in the US works that way. I don't think people care like that. So it's sort of interesting, but one of these stories is that person, it started with $40, and within 2 years, they had 5 or 6 stalls and effectively employed everyone who was unemployed in their family. And I don't know what could really be more impactful, at a lower income level than being able to grow your business to where you can effectively employ your whole family. So that's kind of, I think, at least a goal on the bottom of the pyramid, period. Whether it's a Boda bike in Africa or one in India or something else, is that it can create a lot of scale. And the last comment I'll make on that is, don't underestimate how much entrepreneurial spirit those people have. They might not have gone to Wharton, they might not have much of a background in these areas, but you might be surprised. You loan a guy, you loan so they get a motorbike. A year later, they may have 12 of those, and they may have a whole business around it. Right? It's pretty interesting. And in places like Africa, where, my last point here, the gap, but demographics are interesting because it's one of the very few things we know, right? We know how it's going to play out. You're going to have roughly 450 million people that need a job in Africa, and they call it the next, Edmund will know this better than I, but it's not long. It's like the next 10 to 15 years. The existing system is only going to create about 100 million. So you get 350 million that will have to have a job, and the existing infrastructure is not going to provide even half of that. So, fingers crossed, with the right micro lending, maybe we'll just have a massive entrepreneurial growth in Africa that, sets the stage for the next 50 years. Maybe I'm being optimistic, but something like that is going to have to happen. And a lot of these managers are trying to make that work.
Yeah, no, I think that's a great point. So keying off that, Gloria, Stephen talked about the velocity and the power, the velocity of this money. And I think, again, it was mentioned in the Common Goods report, but I think you also have it on your website, the job creation from these small and medium-sized businesses. It's a huge percentage of jobs created, full stop. So maybe some of your views, and if there's a success or failure story to bring some of these points to life, would be good to hear that.
Yeah, sure. It's so true that job creation opportunity is incredible, right? So I think sometimes we tend to discount that when people are thinking, well, sure, if you give money to a company and they grow, naturally they're going to create more jobs. But in some places, well, first of all, the capital isn't available. So we can say that that's easy, but in most places where we're investing, they don't have that access. So without that money, they can't grow their business and can't create those jobs. The type of company we invest in, the average size of company is about 350 employees. So these are true SMEs. And when they're adding, creating new jobs, they're creating, maybe 30, 40, 50 new jobs. In one case, we had a diaper manufacturer in Peru who, by adding a new line of business, they added adult diapers to their previous, just baby diapers. They were able to actually increase their jobs by over 50% in a particular community where jobs are scarce. I mean, they are the largest employer in that particular community. So that funding for them was huge, right? We have a box manufacturer in Ecuador who has been around for a long time. They are a sustainable company that has been moving towards 100% sustainability for the last 7 or 8 years. And as a box manufacturer, that obviously is critical. And they were actually really struggling at the beginning of the pandemic because the bank pulled their financing and they still needed to be able to meet their contracts and everything. And so we stepped in as a lender. We were able to do it pretty quickly, which also banks have a hard time doing. And this is a great company. Their main off-taker is Dole. They make all their boxes for shipping bananas all over the world. And they are an incredible company from every aspect. They are, there's women in their leadership positions. They promote all kinds of diversity within the company. They have good HR policies. They provide healthcare. They provide, normal things that we take for granted here, but are rare in some parts of the world. And by us, keeping them in business, they were able to keep jobs, but we've recently provided additional financing that was able to increase jobs in their company by about 20%. So, any kind of financing, and you go, yes, these are smaller companies. So, yes, 50 jobs may not seem like that much, but in a community where it's one of the few employers, that 50 jobs is huge. And when you add up, 100 of those 50 jobs, then, you're finally starting to make a difference. So, somebody commented on the security of these loans. And I think that's a common misperception is, wow, these are emerging markets, it must be more risky, which it's the exact opposite. At least that's been our experience, because one, as Ed said, we're senior secured first lien. We typically, because we are the only money around, right, we have an advantage, and we don't want to use that advantage to overcharge the investor or the borrower. So we use it to protect investors. So we get covenants, we get information rights, we get collateral, like we're over 200% collateral in almost all of our loans. Any structure that we put together in the US, a lender would die to be able to have that kind of a protection and structure. In the markets that we're in, it's very normal, right? And so while you might think it's more risky, it's truly completely the opposite. And the other thing I will say is, if you've lived in the US, you know this, we've made it very easy in the US for people to walk away from their debt. And they do, right? In these markets, it's not so easy to just walk away from your debt. They don't have those same kind of laws. And most of the companies we're lending to anyway are privately owned companies that have been in a family for a long time, and they're not going to walk away. They're just not. That's not who they are. So a big misperception is that it is more risky because it's Africa, or because it's, somewhere in Southeast Asia or Latin America, and it just isn't the case.
Thanks, Gloria. So, Patrick, I'm running with your idea here, but maybe trying to multitask. Following up on the points Gloria just made, there's a question about the Cliffwater Direct Lending Index indicates a 0% default rate. I don't know if that's in your bailiwick. If you have a comment on that, if you want to pass it to somebody else, that's fine.
We have 0 defaults as well. And I'm an investor in Cliffwater, a number of private credit funds in the US. And I just say, maybe as a broader point to connect Stephen and Gloria's concept, impact investing in private credit is quite unique. It's not like being in Cliffwater where you're buying notes, or being in a private credit fund in the US where you're helping private equity sponsors buy a company at 4 times EBITDA leverage. Your money is very easily traced to an end use that is fundamentally good, and it transcends all this ESG argument and greenwashing. That when your capital comes into a creation fund or a tri-link fund, or it then is deployed in an underfunded community and being used for economic activity. And you can trace every $1 million that comes into our fund that goes into microcredit is 5,000 more borrowers that wouldn't get that $200 loan if you didn't come in. So I think that helps transcend all the arguments about what impact is or ESG. I mean, is anybody really high-fiving over buying some Tesla stock, saying we saved the planet? But this is where it's real. This is real impact, but you should always do it through an SEC registered investment advisor that's using, properly structured funds, that's doing proper due diligence, and the professionals, real professionals, all the same expertise and structure, documentation that you would want anywhere else. We absolutely need to have in the impact space, and we do, like all the firms, here. But the mission is too important to do it any other way. So for all those groups out there that are looking for opportunities, find a great fund that knows what they're doing, that's been in business for a while, that's regulated under the SEC, that's managing, funds that are properly organized, and that's where you start doing this impact investing, not from your cousin who has a friend who's doing a startup, and those are the worst. Don't touch those.
And a success story or story to bring in your portfolio to bring this to life?
Yeah, I mean, again, we do both private equity and private credit. So we're happy to go up and down the structure. We just took a micro credit company public in India called Fusion Microfinance. So I only bring that up, even though there's a private credit platform, to say these are real businesses that are growing and expanding, that are regulated, they're profitable, they're tech enabled. The capital markets exist. You're not going in a vacuum with these investments, but that's how we bring this emerging middle class into formal financial services and education and healthcare. And we didn't talk about these other industry verticals, but there are a number of other industry verticals that might be a little more nascent than financial inclusion, and private credit is the best way to access them. There are some countries that, again, don't have the ecosystem put together for equity capital markets, but debt becomes a great tool to, again, stay senior, have a cash flow plan. I mean, we get monthly interest that we sweep to our investors. We do 1-2 year facilities. It's just a great way to shorten your risk, but to get that capital injected into underfunded communities. So.
Terrific. Thanks, Patrick. And Ed, your views, and I don't know if there's a particular portfolio company or story that brings some of this discussion to light.
We invest in a business called Watu Uganda. It's a business which is focused on a single financing product. That's a capital strategy that we like. It focuses on a single product that works well. You diverse geographically, but your management team, your technology stack is all built around servicing that one product. We looked at a total of 9 businesses funding motorbike taxis in East Africa. We looked at other operators in other parts of the continent. We know all of the operators, we know the management teams, we know their shareholders. And we were able to evaluate that Watu Uganda is the top operator in that segment. In the African market, we were able to negotiate with them very favorable terms, because in Africa there is less competition in this sector than there is in India or Mexico than Brazil. And we're able to provide them a facility of $7 million. That capital they've been able to use. We've been able to crowd in additional funders. 2 other funders who are very, very close to us have followed on from us. And if we take our money, and then we take the 2 investors who followed us, we've created around 30,000 individual loans in Uganda. Each of those loans is one young person who maybe doesn't have a job, but he's an ambitious, reliable, responsible individual. He now has an opportunity to ride a motorbike every day, take passengers, take people to work, take people to drop off goods at their own customers. They've helped move the world around, but each of those 30,000 individuals have been able to put food on the table for their kids. They've been able to pay healthcare for their parents. They've been able to send their kids to school. And at the end of 2 years, they've paid off that loan. And that individual, before he took that loan, he may have only owned the shoes on his feet, the clothes on his back. And at the end of that loan, he owns a bike. And with that bike, he can then go and get a second bike. As Stephen said, he can build up, and as Stephen, you and I have talked about this in the past, he can build up his own little mini empire in terms of renting bikes out to different individuals in his social network. And that's the positive power of capital in our market. But please don't get me wrong, this is not charity. We're getting very well remunerated for these investments. And it's a truism. In Africa, we've got the people, we've got the birth rates, we've got the demographics. In Europe, Japan, and the US, particularly Europe and Japan, you don't have the people, the populations are falling. You've got the money. The capital comes into our markets. There's a scarcity of capital, it gets a higher return for the risk. And over time, we have economic development. Another way of describing that economic development is that equilibrium being restacked. And in the meantime, you're going to get a better return for your risk. You're going to get, as Patrick says, you'll be investing, and as Gloria say, you'll be investing at a less leverage, better secured basis for the same rates than you will do back home in the US. And the difference between the two markets is putting money into our fund in our world, into Africa. That money is being used to grow businesses. In the US, yes, there's money built for new factories, for carbon transition, but actually a lot of that capital is just going into financial engineering. It's going to re-leveraging portfolios or re-leveraging real estate. It's going for buyout companies with a load of other people's money. Very, very different investment perspective in our world.
Thanks, Ed. So we just have under 10 minutes left, and this has been a very good conversation. I'd like to leave a little bit of time for each one of you to give closing observations. And as I do that, I'm going to try to pick off maybe a couple of these remaining questions. I think we did a very good job of covering them. But Stephen, maybe starting with you, I think the goal to put a capstone on this, I think you and Jeff and your report is what kicked this off in the first place. I thoroughly enjoyed this hour. So maybe some closing observations. And this is a new term to me. There's something called a technical assistance, TA. I've never heard of that term before, but if you have a view on that, somebody's asking for about opportunities in that space. It seems like Ed knows something about it. If you don't, so if you want to take a pass, we can get it when he gets there, but maybe closing observations on your side, Stephen.
Yeah, well, of course, Bill, of all the questions, I think I had reasonably educated answers for all of them except that one.
Grab another one then. Grab another one.
There. Well, I guess, let's see here, because I did look at a few that, maybe I can answer in like 30 seconds. So one of them is on the return profile. I think most people think about this in practice, whether they ask about it or not. This particular person said kind of 10 to 18% in the US. 18%, I mean, anything over 15 in the US, you're talking massive, massive, massive risk. Maybe redevelopment of a busted mall, maybe something like that. So I wouldn't even really consider that end of it. It's not
extreme leverage on it. Right?
Yeah,
exactly.
Like,
Lots of leverage.
I would look to try to frame it where it's a little more useful. I do think, 9 to 12, that is a reasonable ballpark. And where most people are going to see, like, kind of pull that from is either private or public BDCs or some other kind of senior lending. And in this rate environment, that certainly is possible. And if you're in a private vehicle, the standard deviation is relatively low. Obviously, you can look at the public markets to see what the quote real standard deviation is. And I love BDCs. I'm not knocking them, but you got to be realistic. So if you're comparing privates, because that's the correct way to look at this in most cases. US is probably more like 9 to 11 net. And in frontier markets, you can get similar to higher, but the risk profile, the kind of levers of risk being pulled are different. So even a very conservative Ares fund is going to have over 1x leverage. So there's some considerable leverage going on there. And those portfolios are typically pretty concentrated in kind of tech and software, which, by the way, has worked tremendously well, partly because in the pandemic, that sector, by luck or not, did really well. And so it's been fine. Where I would look at it is not even one or the other. This is a key point I wanted to make, Bill, in terms of like framing this whole discussion up. I wouldn't look at it that way. It's a gigantic market with a bunch of different risk factors and upside factors. So private credit is, in my nerdy due diligence view, one of the easiest ways to get smart diversification overseas. It's probably way ahead, frankly, of the competitors. So if you're looking at what you probably have is a large exposure to large firms, so 25 million to 100 million EBITDA companies in the US is probably almost all your private credit exposure realistically, even if you're an institution. Well, if you go down to SME lending, you're hitting a totally different part of the market, theoretically, potentially getting some greater upside. And it's an excellent diversification tool. So if you're looking around, like, how do I get a kind of reasonably safe 10 to 12% yield? I would just say this is another option to consider instead of saying, oh, well, I have to pick US instead of the other. And I can tell you, as someone who knows these statistics pretty well, the default rates for really good managers in the US on levered funds it's good. I mean, it's good. Non-accruals industry-wide are kind of around 2% right now. The really good managers, including coincidentally everyone on this call, their non-accruals are lower. They're lower. So the risk profile isn't, I don't think, as obvious as it may sound, which we've touched on. And in terms of getting some geographical exposure, we know most of the growth in the world is going to be kind of Middle East, Africa in the future. I think just mathematically, that's probably going to be the case. To me, this is a very smart way to get exposure to Mexico, India, Africa, where they've got better demographics, and you can still get a really good return profile without taking like really high equity risks that really you just don't understand. So hopefully not too long, Bill, but those are my initial thoughts.
Helpful, and thank you for that. And thanks for the paper. It was very helpful. Gloria, closing observations.
Yeah, I was going to answer the question about currency risk, and I can only answer for our fund, but most of our investors are US investors. We do have a few that are not, but the majority of them are. And so when we structured the fund, we basically said, look, and as Americans, we don't even understand currency, right? Because we have one currency and that's all we know. And so we basically said, look, we can't take currency risk with this fund. And so how will we do that? So almost by default then, it means that we are financing companies that are somehow involved in the global supply chain. Because one of the things that is not as well known perhaps as it should be, is that all global trade is done in US dollars. Regardless of your home currency, if you have a contract with another country, and you may each have your own currencies, your contract is in US dollars because we are the global reserve currency of the world. So we target companies in countries, either where their currency is the dollar or it's pegged to the dollar, or where they are generating enough US dollar-based revenue that we can lend against the US dollar-based revenue. And then we run all of our models and simulations off of that so that we're really not taking currency risk. If we feel there is too much currency risk, then we would require the company to hedge it, but it's almost always too expensive. And so in those cases, we might not be able to do the financing, but we might bring someone else in to help finance because it's not our investor profile. But I'm sure these guys have, similar experience in terms of who, depending on who their investor is, you manage that currency risk differently.
Thanks, Gloria. An important reminder, we talked about that yesterday, Patrick, on the prep call. So you don't have to harp on that, but your closing observations to put a ribbon on the discussion.
Yeah, I mean, I think for this group, you're an alternatives group. Alternatives are the best way to get involved in real impact investing. That is the vast majority of opportunities. And debt, I mean, for every dollar of equity, there's $4 or $5 of opportunity in debt. And the yields are attractive, and as we've talked about, the operating risk is a lot lower than you'd think. The credit risk is a lot lower. We do have just core emerging market risk as a bucket that can be mitigated through diversification. We use currency hedges on our private credit portfolios, but ultimately there's money in your client's pocket that sits in a family foundation that needs to get put to work, and there are some tremendous impact private credit opportunities to get that money to work. Short duration, getting current yield, but really serving a purpose. And it belongs in a portfolio. It really does. It's not 100% of your portfolio, but it belongs in a portfolio, and it's a great way to get the money moving for mission.
Thanks,
Very
Patrick.
well said, Patrick.
Yeah, I agree. Ed, final word for us.
So we prefer private credit in our part of the world to equity. We prefer that because the markets in Africa are less liquid. And so equity investments, you've got to sell them. The great thing about private credit is you've got a contractual maturity and you get your capital back if you want exposure to this part of the world with the incredible dynamics, incredible economic opportunities which we see, and you want those opportunities with a low level of leverage, then private credit in Africa is the right choice.
Thanks, Ed. So certainly I want to thank the panel. I feel like I was a student here. I had the opportunity to ask a lot of questions, came away a lot smarter. And if I think about where the world is post-COVID, onshoring and nearshoring supply chain seems to be the catch-all. But having a functioning global economic world is one of the very best investments we can make. And I think all of you have done an awesome job of highlighting why we have some responsibility to be considering that as investors. And it's not about conceding returns. It's about making the world a more profitable and equal place for everybody. I think it was an excellent discussion. I'll drop the paper in maybe Liz could do it here. I don't know if she has access to it or not, but certainly I posted something about this on my LinkedIn page, and anybody still listening, you can get it, I think, on Common Good's website, and I'll put a link in it as well. So thank you to all the panelists, to be continued, and thanks for highlighting a very important investment opportunity.